Understanding laggards in investment. Investors often find themselves sifting through various stocks and securities in the financial markets, hoping to maximize returns while minimizing risks. Among the myriad classifications of stocks, the term laggard is often used to denote stocks or securities that are underperforming compared to their peers or market benchmarks. In this article, we will delve deeper into the concept of laggards, their characteristics, implications for investors, and the associated risks with investing in these underperforming stocks. What is a laggard? A laggard is generally defined as a stock or security that shows lower than average returns when compared to its benchmark. This could be an index like the S&P 500 or other similar assets within the same industry. In contrast, leaders refer to stocks that consistently outperform the market or their industry counterparts in terms of returns. Key characteristics of laggards. 1. Underperformance. The hallmark of a laggard is its consistent failure to generate returns that align with the industry average. For instance, if stock ABC regularly generates annual returns of 2% while the industry averages a return of 5%, stock ABC qualifies as a laggard. 2. Investment considerations. Investors need to be cautious while dealing with laggards. Holding on to these underperforming stocks typically results in the first sell-offs during portfolio rebalancing. This is because lingering on a laggard not only stagnates potential earnings but incurs opportunity costs when other stocks perform better. 3. Potential catalysts. Occasionally, investors may choose to hold on to a laggard stock if they believe a particular catalyst will revive its performance. This could be due to expected management changes, anticipating the resolution of legal issues, or projected improvements in company strategy. Risks associated with laggard stocks. Holding laggards can be tempting, particularly for value investors seeking bargains. However, these investments are often fraught with risks and potential pitfalls. Common reasons for underperformance. A stock may become a laggard for numerous reasons, including missed earnings expectations. Continuous failure to meet or exceed earnings forecasts can erode investor confidence. Weak fundamentals, a decline in sales, ineffective management strategies, or an inability to adapt to market changes are indicators of a stock's potential laggard status. Market sentiment. Stocks can become market laggards due to poor public perception or negative press, causing investors to shy away and driving the price down. The bargain fallacy. Investors are often drawn to laggards because they seem like bargains. Low-priced stocks can appear to offer significant upside potential. However, this assumption can be misleading. Stocks priced below $10 may be low for valid reasons, such as a track record of poor performance or ongoing issues that have not yet been resolved. Liquidity and trading risks. Lower-priced stocks tend to exhibit less trading liquidity than their higher-priced counterparts, making them vulnerable to larger price swings and volatility. Investors might struggle to sell these stocks without affecting the market price significantly due to a larger spread between bid and ask prices. Strategic investing, moving away from laggards. Instead of taking a chance on laggards, many financial advisors recommend focusing on institutional quality stocks that demonstrate solid performance metrics. Such stocks typically have 1. Strong earnings and sales trajectories. Companies showing consistent growth in earnings and sales often garner more attention from institutional investors. 2. Stable price points. Ideally, stocks priced at $15 on the Nasdaq or $20 on the NYSE are preferred by institutional investors as they often exhibit more stability. 3. High trading volumes. Stocks with daily trading volumes exceeding 400,000 shares are generally favored, as this provides the necessary liquidity that larger funds need for their transactions without significantly impacting share prices. Conclusion. Understanding the nature of laggards is critical for investors aiming to make informed decisions within the stock market. While some laggards may eventually recover, the risks associated with investing in underperforming stocks are considerable. Rather than gamble on perceived bargains, a more effective strategy lies in prioritizing high-quality stocks that exhibit persistent growth and stability. By doing so, investors can better position themselves for long-term success in their investment portfolios.